Hey everybody, I want to give you a quick rundown on how I pick the levels that I pick and why I pick them. To start with, we want to look at the expected move formula, and this is simply the price of the stock times the implied volatility times the calendar days expiration divided by 365, and this gives you a move to the upside and to the downside. So take note of the equation. We'll go to the charts here. And why do I pick the charts that I pick? What do I look at? I start with the weekly chart, and in this case, Microsoft, I see a bull pennant forming here on Microsoft. So this is a 15-year weekly chart. So I would zoom in, get your trend line here. I always like to start at the peak of the wicks and pull it down and let it touch as many points as you can, but make sure the pattern visually looks nice. Like, you want it to look textbook. So if we drag it through here, we are hitting the corner of that red candle, and then we're also hitting the wick of this candle. So then we would look for diagonal trend line support down through here. So here's a good wick. We could start there. And I like this one spot right here. So there we got wick touching that, we got the corner touching that, we got a corner touching, we got a corner touching, wick. So there's a nice support. So weekly looks really good for a breakout. From here, you could definitely say Microsoft looks like it wants to at least come back to the 232 range. So you look at the other charts, daily starting to break out as well. 2 hour starting to break out. We're seeing a little bit of a bull pennant there forming on the 2 hour. And then 20 minute as well, you can see that bull pennant forming. I normally enter based off watching the 2 hour chart though. But in order to pick the levels now, we see our breakout pattern happening. So we go to Tastyworks or whatever your options broker is, or normal broker. And let's see. You can do this, the implied move for any strike price, and it's going to give you roughly the same calculations because the IV percentage here matches. As price goes out of the money, you see the IVs rising here. So basically, whenever you do any of these multiplications, they all equal out to very roughly the same number. But in this case, Microsoft, we see it's at 222 right now. I would feel comfortable saying that Microsoft could run anywhere between $15 to $20. So you could look at a slightly out of the money contract, or if you wanted to go ahead and pick an in the money, again, it really doesn't matter. These levels are going to be projected out essentially the same way. But we'll look at the $250 call that's out of the money. With my strategy, I like to buy the out of the monies, which gives you time to let the premiums build up, and it's a lot safer. The price doesn't move nearly as quickly because it's so far out of the money. So on bad days, you're really not down that much, and on good days, you can actually be up a pretty significant amount. A lot of my positions end up making between 50 to 100% within the first couple weeks of being in them. Generally less than that. The quicker the play, the better, to mitigate theta loss. So the more time that you can buy, the better. If we're doing 60 days out, so we need to be out of the trade within about a week to 2 weeks or so before, with the trade going our way, it'd be beneficial to be out within a week to 2 weeks. But we can hold it longer if we need. We're just going to make less money as it gets closer into our position, because the longer we hold it, the longer we deal with theta. But anyway, to start projecting the lines, we're getting our breakout. Check our options chain. I like the $250 strike. So pull up your calculators, and you times the current current price of the stock, $222.59. 59 times the implied volatility, which is 29.33%. 29.33% times the square root. This little check mark is the square root, and you have to put in this parentheses. If you're doing this on PC, you have to put in this parentheses. On your phone calculator, it normally adds it there automatically. Let's see. the oh my gosh, days until expiration. 60 divided by 365. That did not do a divide. Close your parentheses, equal that out. That gives you an expected move of $26.46. So you take that 26.46, and all these numbers after the first four numbers you can pretty much disregard. You can use them to round up if you want, make that 26.47. I'm just going to keep it at 26.46. The pennies really are not going to make much of a difference. You're going to be hitting these target zones anyways. So you take that 26.46 and you add it to your price of your stock, and that tells us that from now to February 19th, within 60 days, Microsoft has the ability to move up to $249.05. So we come up here and market. What was that level again? 249.05. That is the February 19th $250 call expected move. Or you can also use that as a target or take profit line, either or. Now we also do the same thing to the downside. $196.13. So that says that from now to 60 days out, February 19th, that Microsoft could also fall to $196.13. If that happens, this position is worthless. So these are your two biggest expected move ranges for the specific contract. Again, any contract is going to be, the math is going to come out to very, very roughly the same. This math is done for this exact specific contract, the $250 call for February 19th. So from here to 60 days out, we can expect Microsoft to have the ability to hit one of these two prices. So now if we want to increase our odds of winning the trade, we would go back to the options chain, and I normally I don't really have a set amount of time in between the contracts. I normally just look for the expirations that I think are going to be the best, and in this case with the February 19th expo, we just so happen to have a January 15th monthly expo here. Normally the monthly expos are better to mark, but you can also mark the weeklies, which I'll get into in just a moment. So from this case, I'm going to take we were at February 19th 2021. I'm going to look at the January 15th 2021, and I always go back to the same strike price, the 250 here. So then we'll take, and we have to do the IV calculations again. 222.59. And if you're doing all this stuff while the charts are moving, because that will happen, just leave your price at whatever it was that you were looking at it to start your trade with. You don't need to keep changing the price every time you go to do a new equation, because it'll generally take you 5 to 10 minutes to plot out all these levels. So a lot of times too, you can jump in the trade before you even plot the levels, and then just plot them afterwards, and you know that's your ranges for the day or for the entire trade. But stock price times 26.23%. Times 26 times the square root of 25 divided by 365 this time. And that is $15.28. So plus 15.28 equals $237.87. This is your take profit long. And this just means that if you wanted to stay in this trade for a little longer than average, you would know that price has the potential to hit $237.87. So that would be a good place that if you're in this trade for 2, 3, 4 weeks and it finally hits that price, sell out. If you're in this trade for 3 days and it hits that price, sell out. But we need to project it to the downside now. 207.31. Now at this level, your contract's not going to be worth a lot. It'll be worth I mean, it won't be worthless, but you're probably going to be looking at around 50 to 70% losses at around this level. But that's your stop loss for long. So if you wanted to swing it and stay in it for a long period, then if it hits that level at any point, you want to get out of it, no exceptions. And then I normally will do the same week of expiration, because most of my trades, when I get in them, I only want to be in them for a week or two. So I normally like to project the closest profit line that I can, which in this case is 3 days out. We'll go here, look at stock price times 41.38% times the square root of 3 days, forgot my parentheses, 3 divided by 365, close parentheses, equals $8.35. $230.94. Now you need to subtract that level. 214.24. So, go ahead and get rid of this. So there you have it. If you wanted to enter the February 19th call, and you would know that your soonest levels that could potentially be hit would be the $234.94 or the $214.24. These are your absolute safest levels that you could trade with. If price comes up and we're really obnoxiously bullish and price hits $230.94, and then it starts to break out of it and push a little bit higher, then you could stay in this trade, and you know that your second target is 237.84 or 237.87. so you could try to ride it up and hit that price target. And if you didn't want to try to ride it to there, if it broke out at 230.94 and you didn't want to try to ride it an additional $7 there, you could even go to after you break out of this price, you just go to whatever week's contract that you're in and do the implied move for that. So if that doesn't break out until December 31st or until like say December 26th, 27th, then you would look at the let's see, yeah, that one expires in 3 days, December 27th. So if that doesn't move until December 28th, then you would look at that week's contract for that week and do your IV calculations on there to find a new take profit level that is closer to whatever your current price is. One good thing that can be helpful is optionsprofitcalculator.com. I like to go here and get an idea of what my trade can be worth, how quickly it can be worth something. So in this case, we know that if price hits $230.94 on Microsoft, here I'll give you a quick rundown. You just go up here, you type in your ticker, you press get price, it pulls up the current price. Sometimes it's a little bit lagging, but you can adjust anything you need. You click select option. In this case, we're looking at the February 19th 250 call for $2.58 roughly, or $2.49. Again, it doesn't matter. The numbers are not going to be 100%. They just give you a rough idea. So we say we paid $2.58 for the contract, and you calculate it out. And this is your profits, basically, of what the option can return if it hits this strike price by this strike date. So we'd say 230.94 is our first target, so 231. So we know that if price hits $231 before December 30th, then our contract is going to be worth, on average, over an additional $100 in return. So if it pops off tomorrow, then this contract would be worth 150, or it would be a profit of $151. The longer, where I mentioned theta earlier, the longer you're in the trade, the more the price decays. Even if you get closer to your strike price, it doesn't matter. The price of it is still slowly decaying. You will gain money, but just not nearly as rapidly. The faster you can get the move, the better. If we got Microsoft today and it blew up and just hit, if we bought Microsoft today at $222.80 and it blew up tomorrow and hit 237.87, so 238, we would look at this, and tomorrow that would be worth almost $381 if that ran to that price target by tomorrow, by the second take profit level. It would be at 381. Or we know that if at any point we want to just ride the second take profit level, we have until the first that contract could be worth over $300 in return. So using the profit calculator really helps to get an idea of what your trade could be worth, when you need to sell it, and sometimes you can set automatic sell prices at these levels too. You can also change this. I have this set to profit loss, but you can change this to like the option spread value, and it shows you the cost of the contract and just whatever looks good for you and whatever makes it easy for you. But I hope that was a pretty decent explanation of what I do. But if anyone has any questions, feel free to let me know.